This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to 30 Deals in 30 Days. I'm your host, Tyler Cauble, as we are going through this challenge of learning how to underwrite commercial real estate every day. I am going live, and we're underwriting a random deal that either you guys have sent me through the 30 Deals 30 Days chat or something that I find. And actually, at some point this week, we might underwrite one of my previous deals, show you what my original underwriting was, and compare it to how the deal actually turned out or might turn out. So today we're going to be underwriting a single tenant net lease deal. These are very common. You'll come across these all the time. Single tenant net lease deals, at least I think that's what this is, according to what was dropped in the chat in 30 Deals, 30 Days, sounds like it is, right? 13 years on the lease, single tenant, triple net, right? I have not looked at it yet because I like to make it a little bit of a surprise for myself as we're going through it. That way you guys can kind of see my reaction in real time. If you want to get access to the underwriting tools, my underwriting AI or the underwriting spreadsheet that I'm using in this challenge, go to crecentral.com/30deals30days, sign up for the challenge, download the app, join the community. You can get access to my course until the challenge is over. You can get access to my AI underwriting tools, as well as drop your own deals in there. Let's see what you've got going on. All right, let's go ahead and dive into today's deal. So this was coming from Jared. He's saying, hey, Tyler, I'm sure you have a lot to choose from to review, but here's a triple net deal that I came across that looks interesting. Still 13 years on the lease, but it is a single tenant. All right, that's all we got. Coach LEX is saying, yeah, I was just thinking about how do I underwrite. I was about to look for templates. I will watch after this stream. Hey, there you go. Well, LEX, we've got the underwriting templates for you, and I'm going to show you exactly how to use them today. Ooh, this is a good one. All right, this is a bit of a layup because it's relatively easy to underwrite these deals. And I mean that from the sense of it's one tenant, it's already occupied. We already know what the NOI is. We know what the rent is going to be for the next few years. So really this comes down to cap rate, debt service, arbitrage. So you'll see the cap rate is 6.75%, but you'll notice that, hey, in some cases, interest rates are higher than that. How do you make these types of deals work in that scenario? And I will show you how to make it work in that scenario. It is a Dollar General. I will say, in general, not the biggest fan, personally, of Dollar General triple net deals. Not that they are bad by any means. Dollar General has great credit. You can get a decent cap rate on it, 6.75% for corporately guaranteed, absolute net lease deal. Not bad. The problem that I have with them is that Dollar General on average stays for like 17 or 18 years in a single location. So after this initial 15-year base term, they tend to leave. Like there's a 40% chance that they will exercise one of their options. Generally what happens is another developer comes along and builds Dollar General a brand new space, and they'll just move into that. So something to keep in mind. You want to make sure that these spaces can be very easily converted into something else. The nice thing about Dollar General boxes, it's a box. I mean, it could very easily be converted into other retail, into other flex space even, some type of industrial. But they're typically in very small towns, very little population, very little traffic counts. So there's just not a lot that's going to be very exciting for another potential tenant. So important to keep that in mind. Watch Me Grow was saying, hey, everyone, Tyler, that's a great idea. Would love to see your underwriting for your deal before and after you got it under contract. Absolutely. We are working on that now. I think it'd be pretty exciting to show you guys that. And Z is saying, let's go day 12. I know, it's kind of hard to believe we're already on day 12. Okay, let's learn some more about this deal. 2024 construction, absolute triple net lease Dollar General in Mountain Home, Arkansas. 15-year lease, has just over 13 years remaining, and boasts rental increases of 5% every 5 years including each of the 5-year option periods. So they will negotiate for a lot of option periods. That's one thing to keep in mind. Like, you might buy this hoping that they leave, and they have 5-year options. So they could be there for another 25 years if they like this location enough. All right, down the road from a hospital, near a high school, $82,000 household income. That's pretty decent. All right, first time I've ever sneezed on air. Hope you guys enjoyed that. All right. Dollar General. Yeah, we all know about Dollar General. They're right down the road from me. Great company. All right. Z is asking, is a small town a good first deal to start with? It can be. It depends on demographics, the metrics of that town. You know, as long as population's growing a little bit, or there's a story to be told as to why this is going to perform well, or maybe you just have a tenant that's in place already. Absolutely, because you can typically get commercial real estate for cheaper in these smaller towns. You can get market share better or faster, which I tend to like. You know, it's kind of nice being a big fish in a small pond in commercial real estate sometimes, although that can open you up to geographic risk, right? I mean, if that town ever goes downhill, well, you know, you've put all your eggs in that basket. It's rare to see that happen, though, if you're buying in the right areas. Like the Southeast right now, pretty secure with how many people are moving there. All right, so the nice thing is this is a very easy deal to underwrite. So let's go ahead and pull this up. Let me see. Okay, so offering price, $2,028,000. Let me zoom in so you guys can see this a little bit better. All right, $2,028,000. Let's make sure we do that right. $2,028,000. 6.75% cap rate. Annual rent is $136,934. You know what? Let's do this. Need to get the square footage. 9319. Not far off from what we underwrote yesterday. 9319. You're not going to have to bring any capitalized rehab whatsoever on that one. Closing costs, I would still probably put it at 30 grand. You're probably not going to be raising capital for this. Typically, people that are buying these types of deals, they're buying them through a 1031 exchange, so you've probably already got the capital in place. Let's just assume 25% down with a 7% interest rate. Remember, it's 6.75% cap rate with a 20-year amortization. We will see where that shakes out. If we divide 136,934 by the square footage, divided by, what did I say it was, 9319? That gives us $14.69 a square foot. Now, this one, it looks like they've got a base term, so it's flat for 5 years, and then it goes up in year 6 by 5%. So we will just underwrite the first 5 years, which means that this is going to be completely flat. Now, I have another spreadsheet that goes way more into detail. We didn't use it for this challenge because it takes probably 15 minutes longer for me to input all of the data. There's just so much more that you have to put into it. This spreadsheet that I'm working off of right now gets me to about, I'd say, 90% certainty. That other spreadsheet will probably get us to about 99% certainty. The problem is that additional 9% certainty takes a lot more time. So this is far more complex than back of napkin, and we'll give you a good idea as to whether this is even worth digging into or not. All right, vacancy rate is 0. However, banks will not give you a 0% vacancy rate. They're going to say it's 5%. Why do they do that? Because at some point you will have vacancy, and they want to make sure that you have something accounting for it. All right, now here's the interesting thing about this. Remember, if you were here last night, we broke this formula. Anytime you break a formula, always highlight it. This equals that times that. Now we have fixed the formula. So I will remove that there. Now, you're still going to have some asset level expenses. We are going to be paying 0% in leasing commissions. I'm probably going to have at least 25 cents a foot. And let's say 50 cents a foot. $5,000 a year. I mean, if we have some sort of, you'll probably spend that on filing your taxes, right? So we'll just keep that there. I will have that increase at 3% per year. Come down here, and we never hit a debt service coverage ratio of 1.25. You really want to see, this is 0.89. You really want to see that at 1.25. Some banks will say 1.2 is acceptable. In most cases, it's going to be 1.25. All right, we got to fix this cell, H26. So equals H26. That cell is fixed. That is the principal pay down for the note. Last night, we had 12 months of interest only. Whenever you buy something that's already stabilized, you're probably not going to be getting an IO period. Now, triple net leases can be a little bit unique in the sense that you might be able to negotiate for other terms that you may not necessarily get on a different type of commercial real estate. We may be able to go to the bank and say, hey, we don't want to pay down any principal over this 5-year period. We actually want interest only for the 5 years. And you may be able to get it just depending on how your balance sheet looks. So I'm not going to make that assumption, but I will show you here in a minute what that could look like if that was the case. All right. So remember, we are not going to be raising capital for this one. So we'll zero that out because this is strictly going to our investors. Look at that. You're losing money every year, right? That means that the tenant is not paying you enough rent to cover your mortgage and all of your expenses. And it ends up being a negative 56% return over a 5-year time horizon. Now, how do you make deals like this work? Well, you might be able to get debt at an interest rate in the 6s. I've started seeing 6.5, 6.75, just more offers in the 6s. Let's assume that we're able to get 6.5%, and I've got a 1031 exchange, so I have to put 50% down. Right, I have that capital, so we have got to put that in there. All right. Closing costs still look fine. Everything else looks fine. All right, now we'll come down here and we'll look at this. So see, it's going to cash flow right off the bat, 3% per year. Not great. Keep in mind, this doesn't include any of the tax benefits that you will get from a cost segregation study as well. And over that time period, we're still losing about 7%. So we would have to bring even more money down. And well, actually, let's fix this. This is saying, so the cap rate that we have on exit is 7%. They've got it at 6.75. Let's just say in 5 years, we're able to exit at the same 6.75. Maybe we will, maybe we won't. You're still losing money on it. All right. So I can do this where I'm doing the syndication route. We've done a lot of deals in the 30 deals, 30 days that have gone the syndication route. I will tell you there's no point in doing a syndication on this type of deal because if we're losing money already without having investors into it, taking up 70% and giving it out to your investors is going to make it even worse. So we're just going to do this because typically these types of deals, unless you're buying them like through a REIT or a private equity fund, they're not going to be bought up like that. So we can't change the rent, right? The rent is where it is, all right? We can't change our vacancy rates because a bank is going to do that anyway. The only thing that we can change is how much of a down payment we are bringing. Let's assume that I bring 100% down. So now I have 0 loan. At this point, it cash flows. We're making 6 1/3% every year. And overall, we get about a 4% annualized cash-on-cash return with about a 20% total return. Now, here's the thing. Let's say that's the first 5 years. Not great, right? But the second 5 years, you get a rent bump. It goes up to $143,780, which is $143,780 divided by 93.19 gives us $15.43 a foot. Now, imagine we're in the second 5 years for a second. So this puts us at $15.43. Remember, nothing else has changed. Our expenses are still going to be relatively the same. We can't have a debt service coverage ratio because we paid all cash. We'll change that back here in a second. Now we're making, 30 basis points more, all right, than we were before. And it comes out to be about a 5% annualized cash-on-cash return. So you're probably sitting there thinking like, well, how the hell do these deals make sense? I mean, even if we put this at 50%, we put some debt on it, it's not going to make any sense until we get to 5% interest rates. Let's see what it looks like with a 5% interest rate. That should totally change the deal. Yep, look at that. Now we're at about 5% cash on cash and 20%. So, I mean, it went up marginally. What is that, 9% over the 5-year period? So the thing with these types of deals, because they are already stabilized, there's not a lot of value for you to add there. Like, it just kind of is what it is. So you're typically paying cash, and the reason that you're willing to take 6% on your money every year, right? Because here's our cash flow, 6.68%. The reason that we are willing to take 6.6% returns on our cash is because, one, I don't have to do anything, right? This is absolute net. I have zero liabilities for the roof. I have zero liabilities for the structure. If a tornado hits it, not my problem. Pay me the rent. I mean, unless there's, some clauses in there that will allow the tenant to not pay rent for, unforeseen circumstances like that. I also get tax benefits out of it, right? So I'll be able to write off the building, do a cost segregation study, and do some accelerated depreciation, right? That will help. The other thing is, if I don't buy a property like this, I mean, let's just say, it came down to this or paying capital gains tax. Well, how much cash am I putting into this at 100% down? $2 million, right? I mean, let's assume that my original principal was $500,000 and I have to pay 20% capital gains tax on the difference of $1.5 million. It means I'm going to walk away with 1.2 and give $300,000 to the government. So I would rather just buy the building, right, and make some money out of it. Now, that's not going to be great for a lot of you guys, right? I mean, it's still, it's still a decent amount of money. I mean, look, you're making $130,000 a year. So don't get me wrong. It's not like that's a small amount of money. If you're just looking at the actual percentage returns for how much capital you have into a deal like this, it just doesn't make a lot of sense. But again, that's why I tell y'all, always go for something where you can create some sort of value. We can't create value in this deal at all. This is strictly a mailbox money play. Single tenant net lease deals are the bonds of commercial real estate. If you're going to go buy bonds, you can expect to get like a 3, 4, 5% annualized return. It's about as safe as it could possibly get, right? Way safer than stocks, bonds are. But because of that, you're just going to get a lower return. It's a safe investment. You can't really do much to push it, right? And so that's why typically the single tenant net lease deals, the only clients that we're representing that are buying those are typically in a 1031 exchange, and they don't want to do any work whatsoever. They just want to get their cash. So typically what I do, like, single tenant net lease deals are in my portfolio in the future. I don't have any in them right now because I am actively creating all the value that I can, because I can make substantially more money that way. But at some point, I'm not going to want to work anymore. I'm going to be done. I'm going to want to spend more time with my family. I'm going to be fine, taking $20 million in cash and getting a 5% return on that, knowing that those have 10 to 15 year leases and I don't have to worry about a damn thing, right? So this is kind of for the end of your commercial real estate career. These single tenant net lease deals are, unless you have a full-time job, right? You're making enough money, you're a high net worth individual, and you just don't want to deal with having to create value in these deals. You just want something that's more secure, that's stabilized, that's more of a tangible asset than stocks. Then these are perfect for you. So there you have it for today's 30 deals in 30 days. Shortest one we've had yet, because single tenant net lease deals are super easy to underwrite. Hope you guys enjoyed that one. I will see you tomorrow for day 13. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.